Okay, let's dive right in. We've all seen the movies, right? The trading floors, walls of screens, flashing red and green lights, just absolute chaos. And yeah, for a lot of people, stepping into the financial markets feels exactly like that. Like walking into this high stakes arena where the jargon is incredibly dense and the volatility is frankly totally unpredictable. It is so easy to let those flashing lights induce sheer panic. But hey, it really doesn't have to be that way. Actually, once you break down the real mechanics of buying and selling equities, stock trading transforms from an emotional gamble into a highly structured, manageable skill. So in this explainer, we're going to completely cut through that noise and decode the process together. Think of this as your systematic blueprint for success. Here's our roadmap for today. We'll hit 1, the basics of shares; 2, choosing your trading platform; 3, understanding market trends; 4, essential risk management; and finally, 5, building trading confidence. Let's get right to it. Section 1. The basics of shares. So, before placing your very first trade, we really need to establish a strong foundation of exactly what it is you're buying. Even seasoned veterans forget these core principles sometimes. Purchasing a share isn't just watching some digital ticker bounce around on a screen. It means acquiring actual fractional ownership in a real-world public enterprise. When a corporation needs capital, maybe to fund a massive international expansion, do groundbreaking research, or literally just keep the lights on and manage daily operations, they issue equities to the public. When you buy that share, you are buying a tiny legal piece of that company's future. And why does this actually matter for your trading mindset? Well, because remembering that you're investing in a living, breathing business really grounds your psychology. You're not just throwing chips on a digital roulette wheel. You are analyzing a real organization's fundamental trajectory. Moving on to Section 2, choosing your trading platform. Let's explore the tools of the trade, specifically the brokers and software environments you're going to rely on to actually execute your strategy. When you compare leading brokers side by side, you've really got to find an exact match for your specific operational goals. Take AvaTrade, for instance. It's highly regulated across multiple continents and offers integrated risk reduction tools, which makes it a super secure choice. Then you have XTB offering zero commission on real stocks up to 100,000 euros a month. I mean, that is an absolute game changer for anyone building a portfolio who doesn't want fees eating into their early margins. Meanwhile, if you're running automated systems, you absolutely need deep liquidity pools and raw spreads starting from zero point 0.0 pips. And that's exactly where brokers like IC Markets and FP Markets really shine. They cater incredibly well to algorithmic traders and scalpers, simply because for those strategies, ultra-low execution latency and direct market access are, well, they're basically non-negotiable. And when we talk about charting software, there is a very distinct evolution between MetaTrader 4 and 5. MT4 is honestly a legend in the trading community. You can think of it as the trusty precision scalpel for Forex purists. It gives you interactive charts, robust automated expert advisors, and it really remains a staple for highly focused currency strategies. But if your goal is to trade a much broader financial portfolio, MT5 is the clear evolution. Think of it as the multi-asset Swiss Army knife. It lets you analyze and trade stocks, commodities, and futures, all from a single interface, which gives you that powerful analytical depth you need for comprehensive, professional trading strategies. All right, Section 3, understanding market trends. Okay, so you've got your platform secured and your software is ready to go. But how do you actually know what to buy based on where the market momentum is heading? Prices in the stock market basically never move in a perfectly straight line. They oscillate based on economic cycles and constantly shifting investor sentiment. But in a bullish uptrend, buyers drive asset prices consistently upward in this really clear staircase pattern. The psychology behind this series of higher highs and higher lows is absolutely fascinating. It's essentially the visual footprint of buyer optimism and, let's face it, greed, completely overpowering seller fear. When you see this confirmed structure, you know for sure the buyers are in absolute control. Conversely, in a bearish downtrend, selling pressure takes over and just pulls equity valuations straight downward. You'll recognize this pretty quickly by spotting lower highs and lower lows, and aligning your trades with this dominant market momentum is absolutely critical. There's this old Wall Street adage that hits the nail on the head here. Trying to buy aggressively during a confirmed downtrend is like trying to catch a falling knife. You usually just end up bleeding. Recognizing when sellers dominate is what protects your portfolio from taking unnecessary damage. Now, sometimes the market just stalls out and prices simply bounce horizontally in what we call a ranging or consolidation phase. The price basically gets trapped right between a defined support floor at the bottom and a resistance ceiling at the top. And honestly, these periods can heavily frustrate impatient traders who are just desperate for a breakout, which often leads to forced, low-probability trades. But here's a really fantastic insight to apply during these phases. If you combine fundamental health checks of a company with these technical chart confirmations, you are going to yield a much higher statistical win rate. Understanding the true value of the underlying business really helps you predict which way that consolidation might eventually break. And that is exactly what separates the pros from the gamblers.
Section 4. Essential Risk Management.
We have officially reached the single most critical stop on our roadmap. Because listen, capital preservation is the absolute most important rule in financial market speculation. You can have an exceptionally profitable strategy, but without structured protective rules, a sudden wave of market volatility can cause catastrophic drawdowns. Enter the 1% rule. This simply means you should never, ever risk more than 1 to 2% of your total account equity on any single trade setup. Let's do the math real quick. If your total capital is $10,000, your absolute maximum exposure per transaction should not exceed $100. The defensive power of this rule literally cannot be overstated. If you adhere strictly to risking only 1%, you would have to lose 100 consecutive trades to blow your account completely. I mean, that is a statistical improbability that practically guarantees you stay in the game long enough to learn, adapt, and eventually thrive. So, how do you mathematically enforce that 1% rule? With automated orders. Think of your stop loss as a financial seatbelt. In the heat of a sudden market crash, a human being might freeze, but an automated stop loss order removes human emotion entirely. It steps in to halt your capital depreciation instantly. On the flip side, a take-profit target locks in your gains based on pure logic rather than emotional greed. Amateur traders have this notorious habit of letting their losing trades run because they hope they'll bounce back, while quickly cutting their winning trade short out of fear. Using these two tools forces you to do the exact opposite. Plus, by maintaining a minimum 1 to 2 risk-to-reward ratio with these orders, you ensure long-term system profitability, even if you're only guessing the market direction correctly half the time. Also, distributing your positions across varied sectors is the ultimate cushion against unforeseen, industry-specific downturns. You definitely want to avoid over-concentrating your capital within just a single enterprise or sector. Give it some thought. If some crazy global supply chain issue unexpectedly crashes the tech sector overnight, having defensive holdings in consumer goods, like, say, the massive companies making your toothpaste and your groceries, well, that can stabilize your overall equity and keep your portfolio afloat while tech eventually recovers.
And finally, Section 5. Building Trading Confidence.
Confidence in the markets doesn't just magically happen overnight, right? It requires structured, deliberate practice. By following 4 distinct phases, you can totally eliminate guesswork and highlight weaknesses in your decision-making. First, practice on a virtual demo account. Learn the software without risking a single dollar of your real funds. Second, keep a comprehensive journal. Don't just write down your entry price and stop loss. Write down exactly why you took the trade and what your emotional state was at the time. This is how you spot your own psychological pitfalls. Third, formulate a strict written strategy checklist so you aren't just guessing during fast-moving, chaotic markets. And finally, you have to master emotional control. Let's be real. Staring at massive red candles while sweating bullets is basically a rite of passage for every trader. But your written checklist is your lifeline when that panic inevitably tries to set in. Ultimately, your long-term success comes down to this core philosophy: executing your systematic plan with strict discipline rather than chasing impulsive overnight wealth. Mastering the stock market is a continuous journey based entirely on probabilities. You must learn to detach emotionally from the outcome of any single trade. Instead, judge your success by how well you followed your plan over a sample size of, say, 100 trades. Thinking in probabilities over a large sample size, that is the ultimate secret to neutralizing the sting of individual losses and building genuine long-term consistency. So, the question is, are you ready to stop gambling on speed and start engineering your success with consistency? The tools are right in front of you. Take your very next step with confidence by opening a free demo account with a regulated broker to refine your strategies totally risk-free. Ask yourself right now if you have the discipline required to truly master the market today. You have the step-by-step foundation. The rest is just discipline. Thanks for joining me on this explainer, and happy trading.